Just a few days ago, on June 16th, BlackRock did something Michael Saylor spent 6 years telling you was impossible. They launched a Bitcoin product that pays you to hold it. Monthly income, an ETF wrapper, and the most trusted name in asset management stamped on the front. And Goldman Sachs is about 2 weeks behind them with a version that's even more aggressive. So here's what every breathless headline is reading this as. Wall Street has finally blessed Bitcoin. The asset class has matured. Everybody wins. But that's not what's happening here. What nobody's telling you is that these products are aimed like a rifle directly at the one thing that made Saylor's empire worth a premium in the first place. And the cracks in that empire are already showing. So today, I'm going to break down exactly how these covered call products work, expose why they're a dagger pointed at MicroStrategy, and ask the uncomfortable question underneath all of it. Is Wall Street validating Bitcoin or quietly putting it in a cage? My name is Lewis, and you're watching The Coin Bureau. Now, before we get into the war, you need the backdrop because the timing here is brutal. Bitcoin is sitting at roughly $63,000 as I record this, down about 28% since the start of the year. MicroStrategy, or Strategy, as they're now called, is at $116, having shed nearly 30% in a single month. This isn't sunshine and rainbows out there. This is a cold, risk-off market. And it's against exactly that backdrop that the two most powerful names in finance decided to plant their flags in Saylor's lane. Which brings us directly to what BlackRock actually built. The product is called the iShares Bitcoin Premium Income ETF, ticker BITA or BETA. It's actively managed, and under the hood, it holds a mix of spot Bitcoin shares and of BlackRock's own flagship iBit. Then it does the clever bit. It sells call options on roughly 25 to 35% of those holdings. Now, for those unfamiliar, a covered call is simpler than it sounds. Put simply, picture you own a house in a neighborhood that might be about to boom. A covered call is you agreeing today to sell that house at a fixed price down the line, and pocketing the cash check right now for making that promise. If the neighborhood triples, well, tough. Your buyer gets the upside. However, you did get your check. That's BETA in a nutshell. It rents out your Bitcoin's future upside to Wall Street for cash today, and hands that cash to you as monthly income. The target yield is a chunky 15 to 25% annualized, and they aim to keep around 70% of Bitcoin's price moves. The fee is 0.65%. And notice that number because it's deliberate. Existing covered call Bitcoin funds like Roundhill's YBTC charge around 0.95%, and Neos's BTCI charges 0.99%. BlackRock just walked in and undercut every single one of them. This is the exact playbook that let iBit hoover up the spot Bitcoin ETF market. Drop the fee, lean on the brand, crush the incumbents. And of course, the executives are saying the quiet part out loud. BlackRock's chief investment officer of global fixed income, Rick Ryder, has been talking up Bitcoin as a mature part of modern portfolios. Their head of digital assets framed BETA as moving Bitcoin, quote, from a speculative, non-yielding asset to a standard component of modern portfolio construction. Translation, we are domesticating this thing. But here's the bigger problem for Saylor. BlackRock is the polite version. Goldman Sachs is about to make it worse. Goldman filed for its own Bitcoin Income ETF back in April, and it's expected to go live around July 1st. And their design is far more aggressive. Where BlackRock writes calls on 25 to 35% of the portfolio, Goldman's range is 40 to 100%. Think about what 100% means. At full overwrite, the entire position has its upside sold off. The fund stops being Bitcoin and becomes a pure income machine, maximum yield, and you participate in basically none of the next bull run. So if BlackRock is offering Bitcoin with training wheels, Goldman is offering Bitcoin in a straitjacket. And it's aimed at a completely different crowd. Goldman is going after high net worth private wealth clients, people who want the label of Bitcoin exposure with the behavior of a bond. So now you've got two titans, BlackRock and Goldman, both selling the same pitch. Bitcoin pays you. And neither of them need Michael Saylor to do it. Now, I know that keeping up with all of this is a full-time job in and of itself. 2 product launches, a collapsing share price, and an options market that barely existed a few years ago. So, if you don't have 16 hours a day to sit watching it all unfold, come and join us in the Coin Bureau Telegram channel. It's completely free, and it's where our team pins breaking news, on-chain alpha, and the market updates that actually matter the moment that they land. The link is down in the description below, and the QR code is on your screen right now. Right, so let's get back to it. Because to understand why these products are so dangerous to Saylor, you have to understand what his moat actually was. For years, MicroStrategy was the only practical way to get leveraged Bitcoin exposure inside a normal brokerage account. Before spot ETFs existed, if you wanted BTC in your IRA, MSTR was your vehicle. It was on the major exchanges, covered by equity analysis, and it offered juiced-up exposure through convertible debt and preferred stock. And because all of that convenience, investors paid a premium, a big one. This is the MNAV, the ratio of MSTR's market value to the Bitcoin that it actually holds. In November 2024, that premium peaked at around 3.89 times. Investors were paying nearly $4 for every $1 of Bitcoin Strategy held. That premium was the moat. It funded the entire flywheel. Here's how that flywheel was supposed to spin. MSTR trades at a fat premium. The company issues new shares at that inflated price, uses the cash to buy more Bitcoin than those shares represent, and Bitcoin per share goes up for everyone. Premium justifies more issuance. More issuance buys more Bitcoin, round and round. But that machine only works above a very specific line. Analysts peg the break-even at around 1.22 times MNAV. Above it, issuing shares is accretive. Below it, every new share destroys Bitcoin per share for the people already holding. So, where is MSTR trading today? Well, about 0.8 times, a discount, below the value of its own Bitcoin. That's a collapse of nearly 80% from the peak. And here's the asymmetry reveal that matters. That premium didn't die by accident. It was attacked in 2 waves. Wave 1 was January 2024, when IBIT and the spot ETFs launched and killed the convenience argument. Why pay a premium for MSTR when you could buy spot Bitcoin at a 0.25% fee? Wave 2 is happening right now. Beta and Goldman killed the income argument. Why hold Strategy's complicated preferred stock for yield when BlackRock will hand you 15 to 25% in a clean ETF wrapper? So the question writes itself. What exactly is MicroStrategy for anymore? And this is where it stops being theory. Because the cracks aren't a forecast. They're already here. Let's start with STRC. This is Strategy's variable rate perpetual preferred stock. And it was supposed to be the next evolution of the flywheel, a way to pull in income-focused capital to fund Bitcoin buys. It was designed to trade at its $100 par value. However, on June 17th, the day before I compiled this, it hit a record low of $89, 11% below par. And that's a problem that feeds itself. Saylor committed to only issuing new STRC at or above par to avoid dilution. But at $89, he can't. So the at-the-market program for STRC has effectively frozen. The capital raising engine just seized up. Meanwhile, investors are walking across the street to a competitor, Strive's SATA preferred, which is holding closer to par and paying a higher effective yield, around 13.7%, versus STRC's roughly 12.9%. Strategy is now losing even the income game. But here's the part that should genuinely stop you. In late May, between the 26th and the 31st, Strategy sold Bitcoin. Only 32 coins, worth about 2.5 million. It rounds to a rounding error against their stack. But this is the man who built an entire religion around the words, quote, never sell. This was their first Bitcoin sale since 2022. And the reason makes it worse. They sold it to fund STRC dividend payments. They liquidated the sacred reserve to pay the yield. Saylor and CEO Fong Li called it a, quote, process test, a way to inoculate the market against future sales. But the market didn't buy that framing. The disclosure knocked about 6% off MSTR shares. The vow was broken, and 32 coins is all it took. Now stack the dilution on top. Between June 8th and the 14th, Strategy raised $209 million by issuing 1.73 million new common shares. Remember, they're trading at 0.8 times MNAV.
Right, if you're looking to trade these latest market moves, whether that's crypto or traditional assets like gold and commodities, then BitGet is definitely worth a look. They've just rolled out their TradFi trading platform, which lets you trade assets like gold and other commodities directly using USDT, so you don't need to jump between platforms. You also get deep liquidity, low slippage, and access to up to 500x leverage. Now, if you sign up using the QR code on screen or the link in the description, you can get up to $50,000 in bonuses. And on top of that, if you complete your first net deposit of $5,000 and place your first trade, you'll unlock a VIP 3 trial. Now that includes up to 38% fee discounts, exclusive VIP perks, and free token airdrops. So scan the QR code, check the link below, and see what BitGet has to offer.
So they're selling equity at a discount to the Bitcoin behind it, directly destroying value for existing shareholders. And where did the money go? Well, only $100 million was used to buy Bitcoin, just 1,587 coins, one of the smallest purchases of the entire year. The other $109 million got parked in a USD reserve, now sitting at around $1.1 billion, earmarked for dividends and debt. So let's pause and look at what that actually means. The company built to relentlessly accumulate Bitcoin is now diluting shareholders, hoarding dollars, and slowing its buying to a crawl. The flywheel isn't just stalling, it's running in reverse. And the people watching this are split right down the middle. So let me give you the honest counterweight, because the bear case is not the only case. On the bear side, of course, Peter Schiff has called it a potential, quote, death spiral. Sell Bitcoin or dilute to service the dividends. And every move worsens this disease. Some analysts estimate Strategy has roughly 6 to 7 months of breathing room before it's forced to sell more BTC or raise more dilutive equity, absent a recovery. Their cost basis sits around $75,656 a coin, which means the entire stack is currently underwater by something like $10 billion. But the bulls are not paper hands here, and they make a real point. Strategy still holds about 846,842 Bitcoin, more than 4% of the entire supply. That is an extraordinary war chest. Firms like Benchmark, TD Cowen, and Cantor Fitzgerald are keeping their buy ratings, arguing the death spiral talk is wildly premature. They point to over $25 billion in remaining share issuance capacity, and the simple fact that if Bitcoin rips back to $85,000 or $100,000, the premium snaps back above the break-even, and the flywheel restarts. And here's their trump card, the one thing Beta and Goldman genuinely can't offer. That is leverage. If Bitcoin moons, MSTR's structure gives you explosive, uncapped upside. A covered call ETF, by definition, cannot. So the honest read is this is a knife's edge, and it hinges almost entirely on the Bitcoin price. Which brings us to the deepest layer of this whole story, the part that flips it. Because don't just cheer for BlackRock here. Look at what the covered call products actually do to you. You bought Bitcoin for one reason above all others, asymmetric upside. The chance at a 10x in a non-sovereign asset nobody could print. And these funds sell that exact thing away. The research firm 10x Research called them, quote, yield traps, and the logic is brutal. These funds are mandated to write calls no matter what the market does. So in the one scenario you actually bought Bitcoin for, which is the melt up, you systematically hand the gains over to whoever bought your call. And history backs this up. Covered call funds like QYLD have a long, documented record of badly lagging the asset that they're built on during bull markets. They are income tools, not growth engines. And there's an irony inside the irony. These products are marketed as taming Bitcoin's volatility, but the fat yield only exists because Bitcoin is volatile. The premiums are juicy precisely because the asset is wild. So they're selling you stability built entirely on instability. If Bitcoin ever genuinely calms down, the yield evaporates. So who actually wins? The issuer collects 0.65% on a growing pile of assets, whether the strategy works or not. The options buyer on the other side captures the upside that you sold. And you? Well, you get a monthly check, a smooth ride, and a front row seat to a rally that you barely participate in. The house collects on both sides of the table. And that is the synthesis that ties this entire video together. Wall Street is actually domesticating Bitcoin. Look at the arc. Bitcoin started as a wild thing, volatile, asymmetric, ungovernable, with no yield and no permission needed. Saylor's whole bet was that he could be the bridge between that wild asset and institutional money. That capital would have to flow through him. But the institutions didn't adopt his bridge. They built their own. IBIT took the convenience. Beta and Goldman are taking the income. And in doing it, they're reshaping Bitcoin's very nature, converting its explosive upside into a tame, quarterly friendly yield stream that fits neatly inside a pension fund's mandate. Instead of setting this wild asset free, they're packaging it into something that behaves like a utility stock. Saylor bet everything on being the bridge. And now the people with the real distribution muscle are building their own bridges and charging tolls to cross them. So for you, here's what to actually watch for from here. First, watch the MNAV. If it climbs back above 1.22, the flywheel can spin forward again, and the bulls are vindicated. Stuck below it, and every raise keeps bleeding shareholders. Second, watch STRC and that $89 price. If it claws back to par, the capital engine reopens. If it shrinks further, the dividend pressure gets dangerous. Third, watch for any more Bitcoin sales. 32 coins was symbolic. A second, larger sale would confirm the spiral is real. Fourth, watch the Goldman launch around July 1st and whether that aggressive 40 to 100% overwrite pulls income capital away from Strategy's preferred stack for good. And fifth, watch the Bitcoin price itself, because honestly, it's the variable that decides everything else on this list. So here's the binary I want to leave you with. Are BlackRock and Goldman moving in a bullish moment, acting as the deepest capital on Earth, finally building real permanent infrastructure for Bitcoin? If so, the MSTR premium could roar back the second BTC rips. Or is this the establishment quietly capturing Bitcoin and domesticating the one asset built to resist them, while Saylor's flywheel grinds in reverse and his premium model dies in 2026? Validation or domestication? Because right now, both stories are reading from the exact same data. Get genuinely opinionated in the comments down below and tell me which side that you land on. Does the MSTR premium survive the year, or is the bridge already obsolete? And if you want to understand exactly how these treasury flywheels flip from a structural bid into a forced seller when the premium collapses, then you can definitely check out our full breakdown right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.